Hello everybody, I'm Greg Hensey and this is the ghbond financial channel. Today we want to talk about blockchain, cryptocurrency, and NFTs. So whether you're new to the space or somebody who's been maybe trading for a while, but you really don't necessarily know the details of what you're trading, today we're just going to cover the minimum, the bare minimum of what I believe you need to be an effective trader or investor in cryptocurrencies. Now, we're not going to talk investing strategy. We're not going to talk about different coins. All we want to do is make sure you understand enough so that whether you're a beginner or a somewhat experienced player, that you know the basics of what's behind what you're trading and some of the key concepts that you need. But before we can really understand cryptocurrencies and their place in the environment of financial trading, we need to really understand a little bit more about the US dollar. So first thing we're going to do is take a look at the dollar. First thing we want to understand about the dollar is that the value of the dollar, and this starts at 1960, ends up at 2020. The value of the dollar has been going down over time. And the reason that's important to know that is it's important for you to understand that your dollars that you hold are a wasting asset. They're becoming worth less over time. Good example of this is my parents sold a house in 1972 for $27,000. That house today is worth about $186,000. It's the same shoebox on a slab with an unattached garage that it always was. In fact, the driveway is still a two-track in the beginning. So the house itself hasn't changed. The value of the dollars you need to buy it has changed dramatically over time. Problem with this is number one, this means your savings are losing value over time. Number two, it means the value of the salary you may earn at your job, your income, your hourly rate, over time that also is losing value. This chart on the right is the same chart, except it's a bar chart showing the yearly change. And you can see a very volatile period here in the 70s and 80s where we got up to 12% loss. Here's a couple tens and nines and eights. So we had some dramatic loss in the purchasing power of the dollar right in this period. You may have also heard that Paul Volcker raised interest rates dramatically in order to calm the situation down. Kill inflation was the idea. And he was successful at that. I know my first mortgage was 16 7/8%. So over time, the inflation rate did drop. The value of the dollar stabilized and everything was good. And we have been in a stable environment ever since. The problem is now today with our latest supply shock disruptions and the current inflation, they don't have the same tools. The government has spent so much money, gone so far into debt, that if Paul Volcker were to raise the interest rates again, he would bankrupt the government. Of course, Paul Volcker's not in charge anymore. Now it's Jerome Powell. And they have laid out a series of interest rates increases for the coming future, and we'll see what happens over time. This is the value of the dollar chart. It's basically the same data in the chart we had earlier, except now we start out with $1 in the 1900 time frame, and we look at how many dollars it takes to buy that same dollar's worth of goods over time. You can see it comes along here and there's an elbow right here that starts about 1971, and the loss in value of the dollar accelerates rapidly from that point. Now, what happened in 1971? A lot of you probably know we came off the gold standard. During this period, US dollars were convertible to gold. There was a fixed ratio between gold and the US dollar. Nixon took us off that standard temporarily, but like all things with the government, once they get away with it temporarily, that means it's permanent. So ever since then, the U.S. has no longer been constrained by how much gold they have, and they've been able to increase the number of dollars and therefore the value of the dollar has gone down dramatically since. It's important to understand that the US dollar now is backed by nothing. It is only the full faith and credit of the United States, which happens to be the most powerful nation and one of the richest nations on earth, that keeps it going. Also, the fact that we are used typically as what's known as the petrodollar, which means that all oil purchases happen in the US dollar. Now, with the recent trouble in Russia, Russia's ruble was dropping, so the government said, okay, we're fixing the rate of the price of gold to 5,000 rubles per gram. Problem is, it's not a true gold standard because they're only buying gold at that rate, they're not selling it. So it will help stabilize the ruble temporarily, but it's not a final solution for Russia. They also raised interest rates 20%, which has definitely helped stop the run on the banks, because once you've pegged it to gold to some degree and you've given people 20%, that's a pretty good motivation to keep your money in the bank and not have a run on the banks. So the fact that this money that we have, and there is no gold-backed currency other than the ruble, even the Swiss franc, which used to be backed by gold, is no longer, hasn't been for quite some time now. So everybody's run away from gold because they like printing these currencies. That's why we call them fiat currencies, because they are generated at the whim or the fiat of the government that is responsible for the currency. And you'll see that if you're working with crypto, the term fiat used regularly to describe currencies that are issued by countries. Now, since the value of our dollar is directly tied to the supply of the dollar, this is a couple graphs on what's called the M1 money supply, which is a value that's released by the Fed on a regular basis. And you can see what happened when the pandemic started. We went shooting from below 5 trillion to up closer to 17 trillion almost overnight. Now, the Fed didn't just go out with a helicopter and spray money all over the place. What the Fed did with a lot of this money is they put it out into what's affectionately known as the system, or the Fed balance sheet, which means that it went to a lot of Federal Reserve banks or other purchase of assets, such as maybe mortgages or perhaps securities. We're not necessarily sure everything that the Fed does with this money, but the net effect is it's a floor under the economy. It helps make sure that the economy doesn't totally disintegrate. And it was a good thing that they kept the economy alive, but they might have, in the immortal words of Bob Dylan, helped them out of a jam, but maybe used a little too much force. We are now sort of in the hangover period from that, and the Fed is, you may have heard, going to reduce their balance sheet, which means this graph, they want to bring it back down. And in combination, separately, they're raising interest rates. Now, the graph on the right is the money in circulation, the currency. This is what more directly affects us. So this huge boost of triple the supply on this graph is from here. We went from 1730 to 2157. So the currency in circulation had a 25% gain. Now, this is important to us because if somebody walks up to the poker table and hands out 25% more chips, we want our share. Well, where do you get your share? Well, sure, we got these little checks in the mail, but really your share needs to come from your income. So if you work from a company, you really need a 25% pay increase to stay even. If you work as a business, you need a 25% increase in your dollar flow. And that's part of where the inflation's coming from that we're seeing today. And that is an important thing to know because it will relate directly in a couple ways to cryptocurrency. Now, on the left, we have the same chart we just showed you, which is what happened to the dollar supply. And you can see it's gone ever more rapidly increasing. On the right, this is what's been happening to the Bitcoin supply from 2009 through 2022. Now, this is a lot longer graph. So here, we're only looking at this little period here, but still you can see that the growth in money has been accelerating. And here, the growth in Bitcoins in circulation has been decelerating. Now, why is this? Well, the maximum number of Bitcoins that can ever be generated is 21 million. And here we're up around 19 million, and it's taken us from 2009 to 2022 to get there. So it's about 13 years. And to get to the maximum from here to 21 is supposed to take another 100 years. And the reason that is as there are more Bitcoins in circulation, the mathematical equations required to generate new Bitcoins, which is called Bitcoin mining, become more and more and more complex. So it takes longer and longer and longer to generate new Bitcoins. And every time you generate a new block, the reward every so often is cut in half. So the growth in Bitcoin is dramatically slowing, where the growth in the US dollar is dramatically rising. Now, this helps to explain why Bitcoin has gone up dramatically in value versus the US dollar, where the US dollar is getting more and more and more supply. The Bitcoin is getting less and less and less supply added every year, and will continue to do so, up to a point where no more supply can ever be added. So this makes Bitcoin more of a rare commodity, which is why its value has gone up against the dollar. The problem with Bitcoin is you have very wide fluctuations in value, and that is because, unlike the dollar, which even though it's being printed like monopoly money, it is backed by the US government. And Bitcoin is backed by nothing. So there's nobody to step in and maintain its stability. It goes for whatever the market will bear. Now, over time, as it becomes more accepted and more in demand, it may stabilize. We don't know what will happen in the future, but it's a possibility that Bitcoin may become more stable over time. Okay, now I think we know enough about the US dollar so that we can understand the differences between the US dollar and crypto. The blockchain is where we store our cryptocurrency, just like the bank is where we store our dollars. Each of the blocks has a complete list of everybody's account and all the transactions that were made. We use cryptography to link the blocks together and also to protect our data in our account so that nobody else can get to our cryptocurrency. So let's look at this in a little bit more detail. Our first step in understanding the blockchain is to go back and look at the guy who created the concept, Satoshi Nakamoto. I assume he's a guy, but there's really no knowledge of who this person is in real life. He remains a mystery. So he had a white paper, and although we spent a lot of time talking about inflation and loss of value of the dollar and supply of the dollar versus Bitcoin, the introduction and creation of Bitcoin really had nothing to do with that. His main idea was to replace the trusted party, meaning banks, credit cards, things like PayPal, with peer-to-peer to create non-reversible transactions. So what does this mean? This means that typically if a merchant sells something, goes through bank, credit card, PayPal, and the person who receives the goods isn't thrilled with them or for whatever reason doesn't want to pay for them, they can dispute with the bank, credit card, PayPal, etc., and get the transaction reversed. So now the merchant who sold the goods is out the goods, they're out the money. The bank and credit card and PayPal had the expense of going through investigation and reversal of the transaction. And so there's a lot of expense and uncertainty built into the existing system. His concept is, hey, let's replace that with peer-to-peer, meaning person-to-person transactions. They're non-reversible. So once that money is sent, it can't be reversed. There's no way that the customer can steal the money back from you if you're a merchant. In order to do that, he wanted to create a digital currency, which ended up being Bitcoin, secured by proof of work, meaning that the entire system was controlled by a group of people called miners. The miners are the ones who created the coin, and they did work on computers that secured the coin and made sure that all the transactions were above board and identified and agreed upon. So that network of miners was what makes the Bitcoin currency possible. Third thing was transaction privacy that happened because of the design of the system. The public address is just a number, kind of like a Swiss bank account, so the actual name of the person holding the address isn't known. You can go on a block explorer, look at the blockchain, you can see all the transactions, you can see all the accounts, but there's just numbers, there's no names. So you don't have to worry about the government putting you on a list because you happen to send money to your friend in Russia, and that friend can get the money directly unless Putin shuts down the internet. So you have total freedom to send not only your money anywhere you want, but as much as you want. I think any of us who have worked with transfers know that there's often limits on how much you can send at once. That trusted party is kind of a pain in the butt sometimes, so by eliminating that, you eliminate not only the reversibility, but you eliminate the loss of privacy and the limits on transactions. Now, to understand the blockchain is really a chain of blocks. The blocks contain all the information. They contain every account, every transaction, and anything that you want to know about the blockchain, you can see on the Blockchain Explorer. It's all public, it's all contained in the block. The blocks are chained together by what's called a hash. A hash is a number. It's kind of like a soup. You put all these pieces of information together and you come out with a single number called a hash. And that's what ties the blocks together, because a new block has the hash of the previous block as a piece of the data. Now you can't go backwards, you can't take a hash and generate a previous block, but going forwards, you can't have a legitimate new block without containing the hash from the previous block. Proof of work is what's done by the miners. They're the ones who generate these blocks, and anytime they generate a new block, there's a reward. In order to generate a block, you're looking for this magic number. The magic number is called the nonce. The purpose of the nonce, it's kind of like if you have this soup full of numbers, the nonce is that last little piece of spice that makes it taste just right. It is a number that satisfies requirements to make it a legitimate block, and the work of the miners is to find this nonce. And once a miner finds the nonce, the other miners in the system validate that, yes, you found the correct nonce. And at that point, the new block is created. And again, the new block still has all the accounts, all the transactions, everything's there. Now, this is somewhat oversimplified, but what we're trying to do is understand how this works without being experts who can go design blockchain. Now, some of the usage concepts in blockchain are, first of all, a transaction. Now, transactions are encrypted. They go from account to account. And you as a person that have an account on the blockchain can send any coin or any NFT or anything that you have in your account to another spot on the same blockchain. Sending it is easy as going into your wallet, putting the address in that you want to send it to, and sending it, and then the system takes care of the rest. So it's very, very straightforward to work with. The address is where the storage is. All of your coins, tokens, NFTs are all stored in your address, and if you're using a wallet, they're not in the wallet. The wallet is what is being used to look at your address. You have a public address that people can see, and your private keys. Your private keys is what makes the wallet yours and makes sure that even though other people can see your things and see your address, they can't get at them because they don't have the private key. Here's a diagram of how crypto works in the real world. Over on the left, you'll see we have the first two are custodial wallets where you own the keys, and the one on the bottom is a non-custodial wallet. That's when you work with somebody like Binance or Crypto.com. You open an account and exchange, and you're looking at the exchange app, and the exchange holds the keys. And the software wallet on the top there, you have a piece of software like MetaMask is a popular one, and you have your keys in MetaMask. With your keys, that unlocks your ability to view your account on the blockchain. So you can get in there, you can see your Bitcoin or other items, and you have the ability to move them because you have the key. Now let me warn you that the key is a collection of 24 words chosen at random to identify your location on the blockchain. That's how you get in. That key is for you and you alone. You never give that to anybody. That key has to remain secure because the moment somebody else has your key, they can go right into your location and steal all your coin. For that reason, since the key is important, some people don't want it residing on their phone or their computer where it could potentially be stolen. And so then we go down to the next idea, which is the hardware wallet, which is a USB stick that actually holds the key. So somebody can get your phone, maybe someone steals your phone, you lose your phone. There's no way for them to get at your coin because although they can see that you have maybe a software wallet, they don't have the stick. They can't get into the hardware wallet. They have no way of getting to your coin because you've taken the key out of the software and put it in a piece of hardware that you keep locked in a safe. With the non-custodial wallet, you don't have the keys. You don't have to worry about any of that. You just work with the exchange app. Now, a lot of people like that. They don't want to deal with keys and they don't want to have to take care of the keys. Exchanges are large. Sometimes if an exchange is hacked, they actually don't let their customers get hurt. They take care of that. So there's a degree of protection. There are some advantages. There are times you may want to use an exchange. However, since you don't have the keys and you can't see your location on the actual blockchain, that means if somebody airdrops something, for example, let's say you hold a bunch of Bitcoin and somebody comes up with a new coin and anybody who holds Bitcoin is going to get a bunch of these new coins. Well, those new coins go onto the blockchain that's held by the exchange and you don't necessarily get them. Whereas if you have a wallet, you get them because now you're looking at your spot. Your spot on the blockchain with an exchange might not even be really yours. It could actually be that you're being given a false exchange, in other words, a made-up exchange that you're working on, and then the exchange itself aggregates all the trades under their own account. So you don't really even trade on the blockchain, you actually trade on a made-up exchange system, and the actual trading that's going on for the real tokens is occurring totally separate from your account. So just when you start to look at an exchange, investigate the exchange, look at transaction fees, look at how they work, understand what you're getting into, and understand that any free airdrops that come to your account are probably never going to show up on your end. They're just going to benefit the exchange. So what is cryptocurrency? A coin is the native token of a blockchain, like Bitcoin for the Bitcoin, Solana for Solana, or Ethereum for Ethereum. These are all separate blockchains. They are competitors to Bitcoin, and where Ethereum was the big one, now there are many competitors. A token is a named entity on the blockchain that trades like a currency. For example, USDT is a common one. It's a dollar stable coin. It's actually a token on the Ethereum blockchain. This can be important because sometimes if you want to move a token somewhere, you have to make sure that you're on the same blockchain. You don't want to try and move a token from one blockchain to another blockchain. It might not work out too well for you. Since you're just typing in an address, you have to make sure that the address you're typing in is on the same blockchain where the token is you're trying to send. Coins and tokens are fungible, meaning one's the same as the other. Every Bitcoin, every Solana, every Ethereum, they're all the same. One's no different than the other. Everyone has the same market value. That's what the word fungible means, which is important because we're going to talk about non-fungible tokens. Here's some of the common blockchains that are popular today. Each blockchain has the symbol for its native coin next to it. Just an example of the idea that there's a number out there. If you're going to be working on a blockchain other than Bitcoin or Ethereum, which are the big two, it's good that you study the chain a little bit and learn what its value is. A lot of these chains were created. They might be great, but not all of them are doing a lot of volume. So you got to be careful that you may get involved in a blockchain and it's doing really well. Well, you have to keep up with that because it may fall out of favor and lose its volume. And as a result, your holdings on that chain may lose value. NFTs, non-fungible tokens. So what is non-fungible? Well, we already decided that fungible means all the tokens are the same. They all have the same price. So non-fungible means that the tokens are different. Each token is unique. Each token represents something that is one of a kind. Examples of NFTs, digital art. You can go on OpenSea and see a lot of this. GIFs, which is just a digital picture. Collectibles, things like art. Music, which is becoming a big thing in the music world. Videos, that helps protect the video content by conferring ownership. Real-world items could be real estate, deeds to a car, tickets to an event like a concert, tokenized invoices, legal documents like deeds, and signatures. Eventually we'll all have our own digital ID as an NFT, and our digital ID eventually will allow us to vote on the blockchain, and then all this ridiculous voting machine ideas and ballot stuffing and things of that nature will all be a thing of the past because everything will be secured on the blockchain and no one will be able to cheat. Obviously, that's going to take a while before we get to that point. If you own an NFT, you can easily prove you own it because it's in your account and no one can manipulate it or get at it because nobody has your private keys. Remember, private keys, those things you never share with anybody. As long as no one has your keys, nobody can get into your account and do anything. You can sell it, and in some cases, the original creator gets a resale royalty, or you can hold it forever and it'll sit there in your wallet as long as you want it to. If you're the creator of an NFT, you can easily prove that you're the creator. You determine the scarcity. If you're going to create a batch of NFTs, you decide if you're going to create 10,000, 1,000, 30. You determine how many there are. You determine what it is that the market is going to see. You earn royalties every time it's sold. And you can sell it on any NFT market, or you can sell it peer-to-peer. You're not locked into any platform, and you don't need any third party to sell it for you. Although people have used Christie's, for example, to sell some of the expensive NFTs. OpenSea is the largest market. You can go to OpenSea.io and you can start looking at these online. Caution you, you're going to see prices. If the price has a diamond by it, that means it's in ETH. Ethereum, that means if it's 1.5, that's not $1.50. That's 1.5 Ethereum. It's thousands of dollars. Bid prices can sometimes be far below asking prices. In fact, if you're selling something for 15 million, it's possible somebody puts 15,000 in there, and if you accidentally accept that price, remember, this is a non-reversible transaction. So once somebody sells an NFT, they can't get it back. Some NFTs include other content. Example, maybe there's an exclusive group that you get into once you own that NFT. There could be airdrops of free NFTs or tokens, or special prices on new NFTs. Prices are unlimited based on supply and demand. Here we have an example of one of the first NFTs, well known, called CryptoPunks. A CryptoPunk is a 24 by 24 bit image inspired by the London punk scene. and there are 10,000 of them. Originally, they were free. So if you were a geek on Ethereum back in the day and you got these for free, then if you had the guts to hold them long enough, you are doing okay now with your free CryptoPunk. The highest sale for CryptoPunk has been 11.8 million for Alien Punk number 7523, and I'm sure this video won't be up long before there's a new highest sale. Here are some of the top ones for sale now. You can see along the bottom there, 27 million, 30 million. Look at this. Here we have a blue guy with blue hair and dark sunglasses. That guy's going for 46.9 million. I'm sorry, I can't see it. But the reason these go for so much is not because of the amazing artwork. Sure, some of them have more features, some of them are rarer, and if you click on them on each individual punk, it will show you their attributes and how rare they are. The reason these go for so much money is because they are one of the first NFTs, and because they are one of the first, they've become collector's items for the rich and famous. And so people with a lot of money treat these like, you know, a Picasso or a Matisse or a Monet. They're a work of art. And although they're not fancy artwork wise, they are rare. There's a limited number of them and they are very collectible. Now, could they eventually lose all their value in the future? Nobody knows. We'll just have to wait and see. But for right now, if you're the owner of a CryptoPunk, you are the owner of an NFT with a very, very high value relative to, obviously, the intrinsic value of the asset itself, which is just a 24 by 24 bit image. Hi, for those of you who made it this far, congratulations. I hope you now have a new understanding level of the blockchain, cryptocurrencies, and NFTs. And I hope you learned two important things. First of all, your tokens are not kept in your wallet. They're on the blockchain. And second of all, never, ever, under any circumstances, give away your private keys to anybody, no matter how helpful or technical or knowledgeable they sound, because that's a sure way to lose all of your cryptocurrency. Remember, keys are what allows people to get into the block. So anybody with your keys owns your coins. Simple as that. So until next time, this is Greg Hensey, ghbond, and we'll see you on the next video.